Welcome to the Deep Dive. This is where we unpack the latest corporate earnings calls to cut through the noise and get to what you actually need to know.
Exactly.
Today, we're pulling apart the recent fourth quarter and fiscal 2025 results, and also the outlook from Boot Barn Holdings, Inc.
Yeah, ticker BOOT for those following along.
Right. Think of this as your shortcut to understanding the key numbers, the management strategy, and, well, where the business stands.
That's right. Boot Barn just wrapped up their fiscal year, and there's definitely a lot to chew on in these results. It wasn't just a strong finish. It kind of sets the stage for some, well, pretty ambitious plans ahead.
Okay, let's jump straight into the headline numbers because they really tell a story of momentum. Fiscal 2025 was a record year for Boot Barn. Mm-hmm. They reported revenue of $1.9 billion, which they pointed out is an increase of $1 billion over just the last 4 years. That's incredibly fast growth.
It truly is. And, that top line growth came with significant margin expansion, too. Merchandise margin grew by 130 basis points for the year. That's 1.3 percentage points, building on a, substantial 500 basis point expansion over those same 4 years.
Wow.
Yeah. And earnings per diluted share follow suit, up 23% to $5.88. So strong bottom line growth as well.
The fourth quarter looked strong, too, didn't it? Really powering that full year performance.
Definitely.
Total revenue increased a robust 17% to $454 million. And here's a key metric. Consolidated same-store sales increased 6%.
And that was driven by what? Both channels?
Yeah, 5.5% growth in physical stores and an even healthier 9.8% jump in e-commerce. So pretty balanced growth there.
Right. And merchandise margin expansion continued its strong trend at Q4, up 210 basis points. So even better than the full year average.
Okay.
All of this translated into $1.22 in earnings per diluted share for the quarter, landing right in their guidance range. Pretty solid finish.
And looking ahead, they gave an early peek at fiscal 2026, noting a positive start with consolidated same-store sales up a sharp 9% in the first 6 weeks.
Yeah, that 9% really caught my eye.
Management credited this early momentum to increased transactions and customers paying full price, fewer discounts, it seems.
That early read definitely got some attention. It suggests a healthy customer right now. But okay, let's dig deeper beyond the headlines and explore the engines driving this business and maybe some of the challenges on the horizon.
Sounds good. So when we look back at FY25, new store growth was absolutely central to that billion-dollar revenue leap over 4 years.
No question.
They opened 60 new stores, finishing the year with 459 locations spread across 49 states, almost everywhere.
And management was clear. These new stores are performing exactly as planned, hitting targets for sales and earnings, and achieving a very quick payback period, less than 2 years, they said.
That rapid payback on new stores is key to their strategy, right? It means they can reinvest in more growth faster.
Exactly. It fuels the engine.
Yeah.
And the margin expansion wasn't accidental either. They detailed several drivers, finding efficiencies in their supply chain, reducing shrink, basically minimizing loss from damaged or stolen goods.
Always a factor in retail.
Always. Leveraging their growing scale for better buying power, and significantly increasing the penetration of their exclusive brands.
Yes, exclusive brands. Those private label products you can only get at Boot Barn. Clearly a strategic focus.
Definitely.
Their penetration, meaning the percentage of overall sales from these brands, increased 90 basis points in FY25 to 38.6%. That's a massive 1,500 basis point increase over the last 4 years.
1,500 basis points. And management said about 1/3 of their total margin growth over that period came specifically from these exclusive brands. So it's a huge part of the margin story.
Because they control the costs and pricing more directly, I assume?
That's exactly it. More leverage there.
Yeah.
Now let's shift to this strategic playbook going forward. The first pillar, unsurprisingly, is continued new store growth.
And they are aggressive about it. For FY26, they plan to open 65 to 70 more stores.
65 to 70. That's about a 15% increase in their unit count in a single year. Yeah, that's fast.
It is. They believe there's potential to eventually double their current store count in the U.S. They seem really confident in that runway, citing the strong performance of recent store classes as evidence.
Doubling the store count. Wow. That would fundamentally change the scale of the business over time.
And for Q1 FY26, expect 10 to 12 of those new stores to open just in this first quarter. They're not wasting time.
Right. Okay, shifting to same-store sales performance, that Q4 6% comp was interesting because It was driven entirely by a 6% increase in the number of transactions. The average basket size was flat year over year.
So more people coming in and buying, just not spending more per visit right now. Interesting dynamic.
Yeah, it suggests maybe the customer is still engaged, but perhaps a little more careful with the total spend per trip.
Makes sense. They saw broad strength across product categories, though. Ladies' Western boots and apparel led the way. Mid-teens positive comps, really strong.
Mid-teens, yeah. Men's Western categories were high single digits positive. Denim was also strong, up mid-teens.
And they mentioned denim was partly just having more inventory in stock to meet demand.
Right.
Better execution there.
Exactly. Work apparel was high single digits positive, while work boots were a slight low single digit negative. So a bit of softness in work boots specifically.
Overall, still pretty broad strength.
Yeah. They're also seeing strong customer loyalty. Their active customer database grew 14% year over year to 9.6 million people. That's a lot of data.
And they're leveraging this data for planning and personalization, trying to get smarter about offers.
Right. And they continue to invest in the physical store experience, doing remodels and adding technology like traffic counters to help measure conversion rates, basically figuring out how many visitors actually buy something.
That acceleration in trends they saw in April and May, leading to that 9% comp start for Q1, is definitely noteworthy. Especially, like you said, since they were facing tougher comparisons against strong performance last year.
Yeah, that's the key point. It wasn't an easy comp. Management believes this reflects the ongoing health of their core customer and just the underlying momentum in the business.
Their omnichannel strategy is the third pillar. E-commerce continues to be a growth driver.
The main bootbarn.com site makes up about 75% of their online sales, and it saw low double-digit comps for the full year FY25.
And they highlighted that halo effect they observe. You know, when they open a new physical store in a market, online demand in that same market often increases.
Right. They use New York as a specific example of that working.
So it's not just one channel stealing from the other. They seem to be complementary. They boost each other.
Yeah, that's the ideal omnichannel setup. They did note that the Q4 e-commerce comp was impacted slightly by lapping an aggressive promotion from the prior year they didn't repeat this year.
Okay, that makes sense.
And also some system upgrades by a major third-party vendor, temporarily affecting dropship availability. So a couple of temporary drags there in Q4 online.
Got it. Okay, now let's tackle the big topic that dominated a lot of the call. Merchandise margin and how they're navigating potential tariff impacts, particularly tied to those exclusive brands.
Yeah, this was clearly top of mind. They expect merchandise margin to be roughly flat year over year in FY26, which notably includes the benefit they expect from another 100 basis points of exclusive brand penetration growth.
So hold on. Flat margin despite selling more high margin exclusive brand stuff. That tells you there are other pressures at play, right?
Exactly. And the primary pressure they focused on is tariffs. They've been aggressively diversifying their sourcing away from China for their exclusive brands.
How much?
Well, 5 years ago, over 50% of their exclusive brand production came from China. For FY25, that was down to 24%. And they forecast it dropping significantly to around 12% in FY26, targeting just 5% in the second half of FY26 and into FY27.
Wow, that's a huge shift in a short time. Real supply chain maneuvering.
It really is.
Yeah.
They also proactively pulled forward about $20 million worth of inventory before potential tariff increases took effect, just to lessen the immediate impact. Smart move if you can do it.
Okay, so that's for their own brands. What about the third-party stuff, the stuff they buy from other brands?
Right. For those products, they've received notices of mid-single-digit price increases starting this summer. Their plan is basically to raise their retail prices by a similar amount to maintain their margin rate on those items. Pass it through.
Makes sense. And for their exclusive brands, where they have more control.
There, it's more nuanced. They're partnering with factories, resourcing like we discussed, and deciding on a kind of case-by-case basis for each product line, whether to, cancel it, order more, hold the price steady, or raise it.
So more flexibility there.
Yeah. They acknowledged they might choose to hold prices on certain key items, like maybe their popular $199.99 boots, even if their costs go up slightly.
Why would they do that? Give up margin?
Potentially sacrifice a bit of margin rate on those specific items to maintain market share or volume, or just that key price point perception. It's a strategic choice.
Gotcha. Did they quantify the tariff hit?
They did. Management estimated the incremental cost of tariffs is approximately $8 million, and they expect this impact primarily in the second half of fiscal 2026.
Okay, so H2 is where the pressure really lands.
Right, and this cost could linger into FY27 if the tariffs remain in place. It's not necessarily a one-time hit.
And what about pricing power? Can they actually pass these costs on?
They express confidence in their pretty good pricing power, noting they've historically absorbed, say, 2-3% increases without much consumer reaction. However,
But mid-single digits is more than 2-3%.
exactly. They do anticipate some elasticity, some softening demand, with the 5% plus increases they expect from vendors being passed on. And this potential softening is factored into their second half guidance.
So they're trying to be realistic about it.
Seems so. They stress that the underlying margin environment, if you sort of mentally strip out the tariff headwind, is strong. They actually anticipate robust margin growth in the first half of FY26 because they'll have untariffed goods and other efficiencies still flowing through.
Okay, that H1, H2 split is important. Let's cover the financial health and the detailed guidance they provided. Balance sheet first.
Sure. Inventory increased 25% year over year, which sounds like a lot.
Yes, that jumps out.
But about 5.7% of that increase was on a same-store basis. The rest was driven by the new stores, the growth in exclusive brands, and that strategic tariff pull forward we mentioned.
So context matters. Is the inventory healthy?
They said yes,
Yep.
Inventory health is good, with markdowns actually below historical levels. And they finished the quarter with $70 million in cash and, importantly, zero drawing on their $250 million credit line. So plenty of flexibility.
That's a strong position. No debt drawn. What about expenses?
It's G&A. Selling, general, and administrative expenses, or SG&A, it deleveraged slightly in Q4 by 10 basis points. Deleveraging just means those overhead costs grew a bit faster than sales, which isn't ideal for margins.
Why did that happen?
They pointed to higher legal expenses and store payroll, although that was partly offset by lower marketing spend in Q4.
Okay, but what about looking ahead, FY26?
Looking ahead, they actually expect to leverage SG&A in FY26, so costs growing slower than sales. And they think they can do this even with a flat same-store sales comp, driven by more normalized incentive compensation payouts, lower expected legal costs, and just spreading those fixed costs across that larger base of new stores.
Ah, the new store is helping absorb overhead.
Exactly. They gave specific leverage points, which is helpful. SG&A leverages, meaning it improves as a percentage of sales, at a flat comp. Operating income, or EBIT, leverages at a 3% comp, and their buying, occupancy, and distribution center costs need a higher 7% comp to leverage.
That's useful detail for modeling. Okay, the guidance itself, wider range than usual.
Yeah, explicitly due to the tariff uncertainty in the second half. So the high end forecasts total sales of $2.15 billion, that's up 13%. Comp sales up 2%, broken down as 1.5% in stores, 7.5% online.
Okay.
Merchandise margin flat year over year, resulting in about 12.4% operating income margin and EPS of $6.40. That's the high end.
And the low end, what if things are softer?
The low end assumes more consumer pushback, maybe from those price increases. Total sales of $2.07 billion, up 8%, with a 2% comp decline.
Ouch.
Yeah. This scenario includes a 30 basis point merchandise margin decline, leading to roughly 11% operating income margin and EPS of $5.50.
But importantly, both the high and low ends include opening those 65 to 70 new stores, right? That growth is baked in regardless.
Correct. The store openings are happening in either scenario.
What about CapEx? Money for those stores?
Capital expenditures are projected at $120 million, but that's net of about $35 million in tenant allowances money they get back from landlords for build-outs. Tax rate expected around 26%.
And Q1 specifically, since it started strong.
All right, for Q1 FY26, the high end guides to $491 million in sales. That 6% comp increase we saw continuing, and importantly, 140 basis points of merchandise margin expansion.
Margin expansion in Q1, before the tariff hit.
Exactly. Driven significantly by 190 basis points of exclusive brand growth benefit in Q1. That yields $1.52 in EPS at the high end for the quarter. Strong start guided.
Okay.
Right.
And they also announced a share buyback.
Yes, the board authorized a new share repurchase program of up to $200 million. Management plans to execute about a quarter of that, so $50 million in FY26 spread quarterly.
That's factored into the EPS guidance.
Yes, it is. They express confidence in generating enough cash flow to fund everything. The store growth, the CapEx, and returning capital to shareholders through these buybacks.
Seems like they feel pretty good about their cash generation. Any other quick insights from the call?
Yeah, a few things. Competitively, They haven't seen major shifts yet. They noted larger players are acting rationally on pricing. They did speculate that smaller mom-and-pop shops could face challenges if these price increases stick, but it's all still pretty fluid out there.
Makes sense. What about how the older stores are doing, the vintages?
Good question. Their vintage store performance remains strong. Stores in their second year are actually outperforming the chain average. And newer groups of stores, say from FY21 to FY24, are showing higher average sales volumes as they mature over time. So the model seems to be working consistently.
That's encouraging for the new store plan. Marketing, anything interesting there?
They touched on the summer calendar. Decent concert lineup this year, maybe fewer huge stadium tours, but more festivals, which actually fits their demographic quite well.
Right.
They mentioned specific sponsorships, the Morgan Wallen Festival, dedicated Boot Barn and Cody James stages at events, sponsoring nearly 1,000 rodeos, plus celebrity tie-ins, like with Riley Green.
Sounds targeted.
Yeah, and strategically, they often look for remnant or last-minute opportunities in music sponsorships. Can be more cost-effective than big upfront commitments sometimes.
Smart. And finally, anything on the CEO transition? Priorities changing.
They emphasize the strategic focus remains unchanged. New stores, comp sales, omnichannel, and margin-exclusive brands. Those are the pillars.
But any specific areas getting extra attention under the new leadership?
Yes, a few things. One, driving better costing and margin structure within exclusive brands. They actually hired a new VP of sourcing specifically for this. Two, putting more marketing muscle behind key exclusive brands like Cody James, Cheyenne, and Idlewind with dedicated campaigns.
Giving them more individual identity.
Exactly. And three, working to reinvigorate the work business that's workwear and boots. Putting a spotlight on it, more marketing dollars, using blue-collar influencers, and even leveraging AI tools to help store staff better serve those specific work customers.
Okay, so refining the execution within the existing strategy.
Pretty much. Okay, so bringing all that together, what does this tell you as a listener trying to understand the investment picture here? What are the key takeaways?
Well, what jumps out to me is the clear underlying business strength. That Q4 transaction growth, and especially the sharp 9% comp start to Q1. I mean, that's well above their full year guidance midpoint. It suggests their customer is maybe healthier than the low end of that guidance might imply. The momentum feels pretty real right now.
Absolutely. I agree. And the sheer scale of their store expansion plan, adding 65, 70 stores this year, and believing they can actually double their U.S. footprint, that's just a powerful long-term growth lever with proven unit economics and those quick paybacks we talked about.
Right. That provides a baseline of future revenue and profit that kind of goes beyond just the near-term same-store sales trends everyone focuses on.
Yeah, it's structural growth. Now, the tariff situation is undoubtedly the primary source of uncertainty.
Right.
It's driving that wider guidance range and the expected H2 pressure.
For sure. But their detailed mitigation strategy, the rapid resourcing away from China, pulling forward inventory, the strategic pricing plans, it shows they are actively tackling it head on.
The key question is just how successful they'll be in passing on costs without seeing significant demand pushback, that elasticity effect.
And their balance sheet is solid. That gives them the flexibility to fund this aggressive growth, their CapEx needs, and the new share repurchase program.
Yeah, that $200 million buyback authorization is pretty significant. It signals management's confidence in their cash flow and maybe their view of the stock's value too.
Definitely. And you should probably keep an eye on those specific focus areas management called out. Improving exclusive brand margins further and revitalizing the work business. Those could be additional drivers down the line beyond just the core store expansion story.
And understanding those different leverage points for SG&A, EBIT, and distribution costs is pretty crucial for figuring out how quickly profits can scale up or down into different comp levels.
Good point. All right, brace yourself. It's time for the segment where we absolutely explicitly state this is not financial advice.
Not now. Not ever. This is purely for illustrative purposes, like hearing a hypothetical pitch from a, let's say, particularly enthusiastic hedge fund analyst.
Okay. Acknowledging that the market and Boot Barn's own guidance is clearly pricing in that second half tariff and demand uncertainty. Here's the outrageous but plausible trade idea pitch. Go long Boot Barn here.
Okay, I'm listening. The argument.
The argument is management is likely being conservative. And the actual underlying business momentum demonstrated by the transaction growth in Q4 and that blazing 9% start to Q1 suggests customer demand is just more resilient than the low end of guidance fears.
Okay, betting on conservatism and momentum. What else?
Plus, their proactive tariff mitigation efforts, the aggressive resourcing, the inventory pull forward might just soften the blow in the second half more than the market currently expects. Maybe the pain isn't quite as bad as feared.
Right, maybe they navigate it better. But here's where it gets really interesting, perhaps. Forget the near-term comp noise for just a second.
Okay.
That massive confirmed store growth pipeline, 65 to 70 this year, and the stated potential to double the footprint represents a compounding growth engine. They're adding high-return assets quarter after quarter. That baseline revenue and profit growth is a fundamental tailwind that maybe the market is underappreciating while it's so fixated on the H2 tariff dynamics.
Yeah, focusing too much on the short-term variable versus the long-term structural growth.
Possibly.
Yeah.
And that $200 million share repurchase authorization, it's not just noise. They're planning to buy back over 5% of the company's current market cap this year alone.
That's management basically shouting, we think our stock is cheap relative to the long-term potential.
Right.
They're putting real cash behind that conviction.
Pretty much. So the aggressive but plausible target. Imagine if they do achieve even just the midpoint of that stated potential to double the U.S. store count over, say, the next 5-7 years. And they maintain something close to current average unit volumes and margin rates. The implied enterprise value could be dramatically higher than it is today.
So the pitch is, bet on the proven store growth engine and management's execution to navigate this temporary tariff speed bump better than the street expects, all while they buy back stock hand over fist.
That's the hypothetical pitch.
Again, that was a hypothetical pitch, not financial advice. Seriously, do your own research, please.
Absolutely. So to wrap up, Boot Barn had a very strong fiscal 25, fueled by new stores and those margin gains, especially from exclusive brands.
They're committing to aggressive expansion going forward. They have detailed plans seemingly to manage the tariff headwinds expected mainly in the second half of FY26.
And they're backing it all up with a significant share buyback program, showing confidence in their cash flow.
It's a business with clear, ongoing, organic growth drivers that's navigating a specific, quantifiable external challenge. They seem to be actively managing the supply chain and pricing levers to mitigate that impact as best they can.
We've tried to give you the essential takeaways from the call here. Remember, this is just for informational purposes only and definitely not financial advice.
Diving into the full earnings materials yourself is always, always recommended. Check the transcripts, the press release, the filings.
We hope this deep dive was valuable for you. If you review the materials and have your own thoughts or questions, well, we'd love to hear them.
That's all for this deep dive. Stay well informed.